Thanks, Doug, and good morning, everyone. Thank you very much, Marie Money, for inviting me back to kick off the second day of what I'm sure will be a fantastic remainder of the conference. So, my title of our presentation today is Today's Hottest Topics in Maritime Investments. Over the next 20 minutes or so, well, perhaps it'd be 21 minutes, I hope to cover some of the topical issues that we've been talking about over the course of the last day or so, and I'm sure a lot of the events and thoughts that are going through your head, and perhaps put a bit of clarity, or certainly sort of give you a feeling for what we're thinking at MSI. There are a lot of hot topics, so I can't cover them all. Hopefully, we'll cover some of them. But I thought as I'm kicking things off, I would just sort of start looking at where the markets are today versus potentially where they were this time last year. And as you can see, certainly from a one-year TC rate and an asset value perspective, we've seen a softening of the markets over the course of the last 12 months for almost all sectors of shipping. The two that obviously stand out are container ships, which continue to outperform, and multi-purpose. We've seen some positive movement there. Some of that has been just riding on the coattails of the container ship market. So where are we on the earnings cycle? You'll see now a lot of the sort of traditional sectors are now on the left-hand side of this chart. That means that fundamentals have weakened. We do expect them to weaken a little bit further, but there will be heightened volatility as we see geopolitical events sort of come to light almost on a daily and weekly basis. LNG has passed the bottom of the market cycle. We don't expect a huge uptick this year, but as we sort of move into the back end of next year, we'll start to see improvements for LNG. And at the top of the pile, we can see container ships and a couple of sectors of offshore. For the offshore sectors, we do think they will sort of bounce around at the top of the peak for a number of months to come. Shipping still remains generally profitable. If we look at the break-even rates, and break-even here, I'm looking at bank debt service and the daily operating costs. That is the stacked bar. The red horizontal line is the one-year TC rate. In general, we can see a gap between the break-even and the one-year TC rate, apart from LNG. And have a look at bulkers. We're sort of the break-even and the one-year TC rate are at sort of similar levels. And I'll come on to talk a little bit about the asset values on the dry bulk side later in the presentation. But I couldn't talk about what's going on today and headlines without mentioning tariffs in some shape or form. And just to try and conceptualize the up and down, the sideways movements of tariffs over the course of this year, I've put this chart up on the left-hand side, which basically just shows you the level of tariffs that the US has pushed on to China over the course of 2025. And of course, we're sort of in a holding pattern currently. We'll potentially see what will happen in the start of July. But of course, that is having an impact on the markets. Now, tariffs are here to stay. They're not going to go anywhere anytime soon. And one of the reasons I say that is if you look at the chart on the right-hand side, we can just see the revenue tariffs have brought in, that spike in revenue over the course of the last couple of months. And I don't think the US economy is going to turn down sort of figures of that magnitude. So moving on to the cargo growth side of the equation, I think it's important to realize that we're in a slower cargo growth environment than we were 10, 15, 20 years ago. That's not to say it's not going to grow, but we're going to be expecting it in aggregate sort of 1.5%, 2% year-on-year growth compared to the 4.5% and 5% growth rates that we saw at the start of the century. From a dry bulk perspective, if we look at the chart on the left-hand side, which shows you incremental dry bulk cargo growth, we can see that from our position as we move towards the back end of this decade, a lot of the growth is going to come from grains, it's going to come from the minor bulks, and not so much from the cape sizes and above. Now, of course, growth in grains, minor bulks is very good for the smaller bulkers. The reduction in iron ore and coal isn't so good for the larger bulkers. But it's not all doom and gloom for the larger bulkers. If we look at the chart on the top right, the exports of bauxite is going to grow quite rapidly, continue to grow quite rapidly, especially out of West Africa, and we're seeing a lot of the larger dry bulk vessels trade bauxite from here. And we will see new cargoes come to fruition. A lot of the cargoes associate decarbonisation. We can see the chart on the bottom right, which is the growth in the cargoes associated with green steel. DRI and HBI, they're going to grow considerably as we move out towards the middle of the decade. So opportunities lie there too. From an oil perspective, we're seeing some structural changes within the industry. Certainly from a consumption side, as we look on the chart on the left, we can see over the last 10 years, China has been the dominant driver for oil consumption growth. If we look at our forecast, it's not China that's going to be driving oil consumption growth. It's going to be other regions. It's going to be Africa. It's going to be the Middle East. It's going to be Southeast Asia. So we need to be looking here for oil consumption growth as we move forward. What we're also going to see as we move forward over the course of the next 10 years is a switch in terms of the dominant supplier, the dominant exporter of crude oil. It has always been the preserve of the Middle East, certainly for the last 50 years or so, but it will move towards the US and the Americas more broadly, as we can see on the chart on the top right. Now, one of the reasons that the North Americas is going to start to dominate crude exports is because in the Middle East, what we're going to see is more and more product exports. As the Middle Eastern economies look to sell a higher value product, we'll start seeing more and more products coming out of the Middle East. This is, of course, an opportunity for product tankers, and more specifically the larger product tankers, because a lot of this product is going to be moving to Asia and to the Atlantic Basin. On the container ship side, we do expect continued growth for the next 4 or 5 years. Again, it's not going to be driven by those main lane trades. We're going to have to look more towards the smaller, the intra-regional trades, the non-main laned east-west trades to really help drive growth. Now, containers is, of course, one of the sectors that is most hit by tariffs, and it's quite difficult at the minute to tease out what I would say is true demand on the container side versus what is front-loading, trying to beat the sort of tariff position. The chart on the top right just shows you the sort of year-to-date position for Asian containerized exports to the US, and you can see that we've seen a huge jump up over the course of 2025 from a lot of those routes. Now, one positive opportunity potentially in the container ship market is container boxes going into Africa. We're already seeing MSC is deploying 24,000 TEU container ships into West Africa. We do think that that is going to continue, certainly the growth. And even if you just look at the population growth in Africa, we can see some quite stark and quite impressive numbers. I mean, in the next 10 years, we're looking at Nigeria growing by about 50 million people. That, with it, is going to introduce more containerized demand for goods. There are other opportunities in shipping from a demand cargo perspective. One of these being LNG. This is just looking at demand in isolation, not looking at supply, but we can talk about that in a minute. We're seeing some very strong growth rates on LNG perspective, over a 50% increase over the course of the next 7 or so years. And it's still one of my favorite charts, even with the US sort of pulling out of a lot of the offshore wind developments that were potentially planned. That chart on the right still amazes me, just how much offshore wind energy generation is set to grow over the course of the next 20 or so years. So certainly opportunities here. Now, as I always mention China comes up so often, but as we all know, the Chinese economy is slowing. As we know, the Chinese economy is developing. So we have to look elsewhere, potentially from a geographical perspective, to where growth will come from. And India is potentially the obvious answer. We can see the aspirations for the Indian government in terms of the Indian GDP per capita, and that is set to go through the roof between now and 2047. We can see that the middle classes in India will match that of China by 2040 and overtake it by 2050. And with this will come volumes of cargo imports into India and fill some of the void that would potentially be left from China. But cargo growth only tells us one part of the equation when we're looking at the cargo side. We have to translate cargo growth into the demand for shipping. And that has been very important in the industry over the last 10 years, with inefficiencies, the increasing of ton miles, the slowing down of vessels, really sort of dictating how many ships we need to move these cargoes. And of course, the deviations around the Cape of Good Hope. We were seeing potentially more vessels going through the Suez Canal. I think people have sort of taken stock on that over events over the last 7 days or so, and are going back around the Cape of Good Hope. And this is just a simple screenshot from our new platform, MSI Seascape, and you can easily see the deviations, the routes around the Cape of Good Hope for all vessel types are very prominent on this map. And just to try and emphasize why it's so important to translate cargo growth into shipping demand, I put these two charts together. These look at 2024. So the chart on the left-hand side is straight cargo growth versus straight year-on-year fleet growth. You can see a lot of sectors, the majority of sectors, almost all sectors, are in the red area, i.e. fleet is growing faster than trade, which is a negative from a fundamentals basis. If we look at shipping demand growth, however, and we also look at the available fleet, so we take into consideration the fact that all vessels don't trade necessarily 365 days a year. Vessels that get delivered on the 31st of December, should only be counting them for 1/365th of a year rather than a whole year. We can see that we get a very different equation when we put those two elements together, and we move a lot of sectors into the positive territory, and that helps explain why the container ship market was as strong and continues to be as strong in today's market. Now, these inefficiencies and increase in shipping demand versus cargo demand have been an item of the industry for some time. The chart on the left just shows you shipping demand growth, the premium it has had over pure cargo growth over the course of the last 10 years or so. And we can see some very important and significant numbers on that chart. Now, of course, the big question is, what happens if we start going through the canal once more? What we can do with the MSI Horizon platform is we can change the availability of canals. And just to give you a scale of what the 0% availability or 100% availability would do to two sectors that do go through the canal in quite large volumes, Panamax bulkers and LR2 tankers. Certainly for the LR2 tankers, it's almost a 30% swing in the one-year TC rate, whether vessels go through the canal or don't. So moving on now to supply and shipbuilding. 2021 to 2024 was a real sort of purple patch for contracting. So much so in 2024, that was the second highest contract in total that we'd seen ever. That means that if you wanted to go and order a ship at a shipyard now, as we can see from the chart on the left, you're probably going to have to wait until 2028 to get your vessel delivered, unless you've got a good relationship with the shipyard or potentially you want to pay a premium. Now, what has become very interesting from a shipbuilding perspective is what's happened over the course of this year. If we concentrate on the chart on the right and the red line, we can see contracting volumes have fallen off significantly over the course of the last 6 months. If we look at the shares at the back, which shows you where orders have been placed in terms of the building market, we can see that China last year took around 75% of all orders. China this year has taken only about a third of all orders. So there's been a huge swing in appetite for both ordering and builder. Now, of course, some of that will be driven by the USTR 301, potentially, which we heard a lot about yesterday. And there are a lot of vessels on the water that have been built in China that will be exposed to the USTR. We sort of just did a breakdown here on the left-hand side. For about 50% of all those vessels that are potentially applicable to have the USTR and have to pay the fees have been built in China. Now, of course, not all of those vessels will call into the US, but the problem is that when you have a vessel and has something that means that you can't trade to the US, if you go on to sell that vessel, if you go on to charter that vessel, you're limiting your options to your counterparty. So people are starting to take note of this and start considering the way that they move in terms of ordering ships and the way they buy ships and the way they charter ships. And of course, the USTR has been put in place to help generate shipbuilding in the US. We're starting from a very low base, and it will take time to get, I think, any significant volume coming out of the US. So what that means for the minute is that it's a real good incentive, it's a real positive for both the Japanese yards and the Korean yards, which we think will benefit from the current USTR directive. Now, looking back at the fleet side, the age profile of the fleet continues to be skewed to older vessels. And we can see in the chart on the left where I've broken down the fleet into vessel types and vessel sizes. The fleet, in many instances, the average age of the fleet, those coloured in light green is over 15 years old, those coloured in dark green is over 20 years old. We can see for a lot of the smaller vessels, this is increasingly becoming a problem. If we compare that to the order book as a percentage of the fleet over 15 years old, which is the red and the orange are the indicators of where we're seeing a strong order book, interestingly enough, you don't get any green bars that are aligned with the red or orange bars. So we're ordering bigger ships, and for the vessels that are older, we're not currently got enough in the order book to replace those older vessels. So there are opportunities that still exist for ordering, I would say, smaller container ships, smaller bulkers, and smaller tankers. Dual fuel remains, of course, and decarbonisation remains an important topic. We're still seeing ordering for dual fuel, but it's still centred on container ships, car carriers, and larger vessels. We do think we will start seeing more orders for dual fuel vessels, and the reason behind this is the IMO midterm measures, which will potentially be signed off in October. If we look at the penalties associated with burning the fuels that we were burning in 2024, and we've done this looking at our MSI Seascape product, if we assume what happened in 2024 continues to happen year on year as we move out to 2035, the actual penalties that will be in place by the IMO will be almost as high as the fuel costs. So we can see our estimate on fuel costs is 116 billion by 2035. The penalties would be $95 billion. That's a huge incentive to go out and do something in terms of ordering vessels with new fuels, or alternatively, investing in the fuels and the infrastructure associated with them instead. So the last section is earnings and values. As we expect to see cargo growth growing at relatively slow rates over the course of the next 2 or 3 years, as we expect to see a lot of supply hit the water coming out of those yards between now and 2027, we do expect to see a softening in earnings. It is a softening. If we compare our forecast for earnings versus the decade averages, which is the chart on the right-hand side, we can still see earnings are at or above those historical averages. So I would emphasize it's a softening. Something similar we expect to see for new building prices. And we do expect to see new building prices soften. They have softened already. And that is simply because when you see more deliveries, then you do contracting, you see forward cover at the shipyards fall. And what the shipyards do is drop their prices to try and attract new orders to keep the order book ticking over. And you can see there's a very good relationship between yard forward cover and prices, and as you can see, we expect to see that new building prices fall as we move forward over the course of the next couple of years. I said asset prices for some sectors remain sticky, and I tried to encapsulate that by a slightly different type of analysis. What I've done here is just to compare where the depreciation is of a range of sectors of shipping and different ages of ships. Typically, when you see weakness in a market, you see a very pronounced convex curve. When the market improves, it approaches straight line, and in very strong markets, it goes above straight line and it's more concave. So what I've done here is compared the depreciation curve versus straight line depreciation. So if you see 100%, it means currently that asset is depreciating on a straight line basis. We can see for tankers, most things are straight line or above. For bulkers, all new tonnage, modern tonnage, again, it's depreciating at a straight line, even though we've seen a softening in the fundamentals. You'd expect to see that depreciation curve move towards more of a concave shape. Container ships going great gun, as I say, so that is actually concave. So we're seeing a strength in the depreciation there. And on the gas side, apart from LNG, again, we're seeing strength. So everything at the minute, or a lot of sectors and a lot of ages at the minute, are still following straight line depreciation, which suggests a very strong market. And this also suggests a very strong market currently, although asset prices are probably a little bit inflated. This is our view of market value in aggregate versus discount cash flow forecasts. And we can see for dry bulk container ships and oil tankers, we have a disconnect currently between the DCF value and our market value. So finally, where are the sort of true opportunities from an IRR perspective, as I usually try and put up at this conference? And I guess I've cheated a little bit, given where the markets are and our forecast for them to soften. So what I've done here is say that we're going to buy ourselves a 10-year-old, and we either buy it today or we wait 6 months and we buy it at the start of 2026. And where are the best IRR returns? Now, buying it today is the blue bars. And you can see in some instances you're actually going to be looking at negative IRRs. And that essentially is because you're buying at a high market and you're going to sell potentially in 5 years at a slightly lower market. But if we wait 6 months, when we've seen some of the realignment in asset values, we do expect to see a lot stronger IRR returns. And that's everything I had. So thank you very much for listening.